Thank you guys for joining us for today's webinar. STL, Silver's Traders Lounge, welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Our guest today is Carley Garner, and our theme is key metrics for trading commodities. Welcome, Carley. Carley is an experienced commodity broker with www.cgarner.com, a division of Zena in Las Vegas, Nevada. Carley is the author of Higher Probability Commodity Trading and a trader's first book on commodities. She also has another book, which she will explain to us in the course of the interview. Carley Garner has become an institution in the industry. She has been quoted in the likes of the Wall Street Journal, Brown, #39, and Investors Business Daily. She also writes a monthly column for Stocks and Commodities magazine. Her market analysis is featured on CNBC, Mad Money with Jim Cramer, and Bloomberg TV. Welcome, Carley.
Thank you.
Having you on board at our trading lounge.
I appreciate it. It's good to be here.
Yeah, so you can start by telling us what made you, given your trading success so far, what made you narrow down to commodity trading, currency futures, and then through your hedging via options?
Sure. Okay. So, I mean, one thing that I've learned in this business is any type of success anyone has in trading is temporary. There's always something lurking around the corner to ruin a trading account or even ruin a life. I know traders, especially we're coming off March, 2020, specifically April 2020, in which, I knew traders that had been around and successful for decades maybe, and almost lost everything in March. So it was last year was a really good reminder that always manage risk first and then worry about trying to make money second. And the reason being, obviously the oldest saying in trading is if you run out of money, you can't trade, obviously. And so that's kind of the name of the game. Just always be focused on managing risk. Don't leave a lot of naked exposure out there. That was a lesson that we learned in 2020 as well. We've kind of shifted from encouraging, like we're a brokerage firm, that's our bread and butter. And we have started encouraging our clients to not trade naked unless they have a sizable account. I mean, if you have a really big account and you can cushion the blow and manage risk by wherewithal, that's one thing. But the average small to medium-sized trader really should always be sticking to limited risk strategies, whether it's vertical spreads or at least make sure if you're trading futures, make sure you have a stop in, that sort of thing. So to answer your question, I really just stumbled into commodity trading. It's not something that I planned out in advance. It just kind of happened. Out of college, I was looking for a job. I landed in a brokerage firm here in Las Vegas, and the rest is history. I've loved it ever since. I mean, it's not easy for sure. This is like I said, a really tough business. There's highs and there's lows, and the highs are really, really high and the lows are really, really low. So it's a learning experience, but I like that about it because it keeps things interesting.
All right, and you're a commodities specialist and you have books you've written on commodities. So like in a nutshell, because of time, what metrics do you normally look out for when you're trading commodities like gold, oil, even wheat and corn? I normally follow some of your YouTube webinars, and I normally see the kind of commodities that you specialize in. So what do you normally look for that you can educate us today?
Correct. So we do, we really focus on any market that has sufficient liquidity. We're looking at to see if we can find some sort of an edge there, or at least what we think might be an edge. Of course, we never know until after the fact. But so we're looking at corn, soybeans, wheat, the meats, which is kind of rare. You may not even be aware that these markets exist in some cases, but there is actually a lean hog futures contract with associated options that trades on the Chicago Mercantile Exchange. So trading hogs, cattle, those sorts of things. And then the more mainstream stuff, currencies, treasuries, stock indices. So we do a little bit of everything. Just recently, on Tuesday, we were some of our analysis was featured on Jim Cramer's Mad Money regarding silver. There's a lot of people watching the silver market because of all the hoopla with the Reddit traders and the short squeeze that they attempted a week or so ago, which honestly didn't have a huge impact on the price of silver. Silver rallied from roughly 25 to 30, but it did in a very short period of time. So that disrupted the market a little. But what was more interesting about that is what that movement or whatever you want to call it, attempted takeover of the silver market, what they really disrupted was the option market. It was very unfortunate for anybody that had any option trades out there. I mean, unless they were long options. So to give you an idea, on the Thursday before the internet decided to short squeeze silver, there were call options, like for example, the March silver $30 call option that was well out of the money was worth about $500 or so on Thursday. But by the time the market opened back up on Sunday, because they had the whole weekend to tweet about it and to get everybody interested, that option was worth 15,000. So if you can imagine being short that option, that's exactly why a few minutes ago I mentioned smaller traders should not have open-ended risk. They should not really be selling options. If they do sell, well, I'm not saying they shouldn't be selling options, but any option they sell should be hedged. Because of that situation right there, it's hard for most accounts trading size or smaller accounts, even if you're trading a one lot, to be short an option that goes from 500 to 15,000 basically almost overnight. On the flip side of that, anybody that was long that option had an awesome night. So there's been some interesting things going on for sure in the commodity space.
All right. And then when you're dealing in agricultural commodities, just explain to us what seasonality is and how relevant it is for commodity traders.
Okay, so seasonality is something that stock traders maybe don't pay attention to, but in commodities, it's a big deal. And the reason being, especially if we're talking about agricultural commodities, so things like corn, soybeans, wheat that have a growing cycle. Corn, soybeans, and wheat in some ways has a relatively steady supply source because they're renewed every year. It's not like something that has a limited supply. So there's always supply coming down the pipe, but the problem is there's not always enough supply to be met at any particular time during the year. And of course, some crop years are better than others. But the bottom line is those markets, not always, in fact, this year, they're doing the exact opposite of what the seasonals say they should be doing. So it doesn't work all the time. It's just one other tool. It's not something that you can bank the bet on, or bet the bank on, I should say. But generally speaking, they have different times a year in which the commodity tends to be overvalued and tends to be undervalued. For example, during harvest in the fall, like in the October area, usually corn, soybeans, and maybe even wheat. Wheat's on a different growing cycle, but that's a whole nother story. But corn and soybeans are usually finding some sort of annual low during the harvest, which is in October. This year was quite the opposite. This year, they rallied a little bit and then literally just kept rallying and haven't really stopped since. We've paused, but I'm not sure that we can say the rally's over quite yet in soybean and corn. Some of the other markets, for example, like crude oil, also have seasonal tendencies. Different times a year, for example, this is going to be an interesting year for crude oil as well, because usually crude's on a downswing during this time of year, and then we usually get a little bit of an upswing as we go into spring because the markets are preparing for the summer driving season. So in other words, seasonals are based on the idea that different times of year, certain commodities are either more or less supplied or more or less demanded, depending on the behaviors of human, and those cycles happen most years. I would say seasonal tendencies generally work 8 out of 10 years, but of course, if you happen to be on the wrong side of the trade on the 2 out of 10 years, you're going to be really sorry you were, because seasonals work most of the time, but when they don't work, it's generally the exact opposite. A lot of kind of like what we're seeing in soybeans this year, they didn't follow their seasonal tendency. Instead, they did the exact opposite. So it's interesting stuff, but definitely something to keep an eye on.
All right, thank you. Hello, Carley.
Hello.
Gilbert here. I just had two questions. One, why is trading high probability setups? Why is it important to concentrate on high probability setups in terms of rewarding, getting better rewards in the long term?
Sure.
Or why do higher probability setups tend to give better returns in the long run?
So we all know that trading is a mental game. We can all, I think, agree on with that. And the key metric in trading is to behave in a way that will keep your emotions in check. If you're not doing so, if you're trading out of boredom, if you're over trading, just trading to trade, just because you're not waiting for all of your signals or all of the bullet points in your strategy to align, there's a good chance you're going to get yourself into trouble, and that's stressful. And then once that happens, once we lose our mental stability, well, I mean, we're humans, it tends to be kind of a snowball effect, right? And then we start making bad decisions, and then those bad decisions feed on one another, and it never ends well. So the idea of using higher probability setups is really just being patient. It's the same way as saying, let's be patient, let's wait for all the stars to align, and then maybe give it a shot. And even then, I mean, there's times the last couple of months we've run into situations where all the metrics that we generally look at come into line and everything looks great, but the trade doesn't work out because simply there is no guarantee in trading, obviously. But if you're doing all the right things and putting the odds in your favor, hopefully in the end you're going to have good times and bad times, but hopefully in the end you're moving in the right direction. Of course, again, a lot of it depends on fate and luck, because nobody knows what's going to happen tomorrow, especially in this type of environment where we've got politics playing a role, especially in the US, global as well. And then we have coronavirus, things that we've never dealt with before. So it's a really tough environment for some traders. For trend traders, on the other hand, trend traders are probably actually doing very, very well, because the markets they've picked a direction and they just continue in that direction. So this has definitely been a year where some strategies work a lot better than others. But again, waiting for the higher probability setups is just comes down to patience, and that's always a good thing.
Okay, and I had one personal question.
Mm-hmm.
Now, I've been trying out carry trades in the spot Forex market.
Okay.
And usually the biggest challenge with carry trades is hedging out exchange rate risk.
Mm-hmm.
Is there a way to hedge out exchange rate risk using Forex futures?
I mean, there is, yes. So the advantage of you're always going to have some risk, and the thing is, if you hedge perfectly, then you have no profit potential, right? So there's a trade-off. But you in Forex futures, it operates a lot different than Forex. So your strategy, like if you're looking for interest rate differentials and things like that, in futures it might not work the same as it does in Forex. In futures, like if you're trading currency futures, you can hedge or speculate price risk, but there is no interest payments or anything like that, such like you see in Forex. You're not paying or receiving any interest, so it's a little different animal. You can definitely hedge your price risk, but again, there really is no such thing as a perfect hedge. And I mean, but yes, you can. The nice thing about the currency futures is they have different sizes, so it's similar to Forex. In Forex, you can choose if you're trading 100,000 units, 10,000 units, whatever it is. In currency futures, they've created micro contracts, so you can trade the micros, which are 10,000 units, relative to the full size contract, which is 100,000 units. So you can pinpoint your hedges, or you can scale in and out of your hedges. And also, currency futures are a little more regulated, so you don't have to worry about counterparty risk. If your positions work out, you don't have to worry about actually getting your money out from the broker. That's a guarantee. I know in Forex sometimes that's an issue, not always, but on the rare case it is. So I mean, to answer your question, honestly, it's not something that I've done actively, but I think it's worth exploring. I think it definitely could be done.
Okay, thank you.
Mm-hmm.
All right, I think you can now share your screen and Just take us through how you identify key metrics when you're trading commodities.
Okay, sure. So what I've done is I've just kind of written out a list of markets that I'm just going to kind of go over live charts real quick and kind of show you some things that we're looking at. I do have, can you see my screen, the little video? Okay. Okay, I'll go ahead and start then.
Okay.
So we're going to, you can see it changing?
Yes.
Yeah.
Okay, all right, just making sure. All right, so this is my contact information. If anybody has any questions, you can reach me at decarleytrading.com is our website. I'm also on social media, so check me out at Twitter, Carley, handle at Carley Garner. We're on YouTube, Instagram. I do post a lot of dog pictures. If you're not a pet lover, you may want to stay away from my Instagram. This is Frankie, by the way, and these pictures, believe it or not, are taken outside of Las Vegas, only about 20 miles from my house. Most people think of Las Vegas as desert, but we do have mountains and trees. Just quickly, I'm a broker, strategist, author. I do write content for Mad Money and Bloomberg Television's Option Insight segment, but I also write newsletters for our clients. So if you're interested in taking a trial of those newsletters, you can sign up on our website. And I have written a handful of books. If you're interested, go to tradingcommodityoptions.com and you'll find a bunch of information there if you're interested in trading commodities. These books, between these 3 books, you will learn really just about everything you need to know, everything to the initial steps of opening account, picking a platform, analyzing the markets, option strategies, that sort of thing. One more quick note, we also have a mobile app. So if you're not into email, most people don't do email anymore, you can sign up for a free trial of our newsletters through our mobile app. Just search for DeCarley Trading in your app store. Okay, also want to just make sure that everybody knows that there's substantial risk of trading. There's no guarantees you're going to make money. Sorry, that's Frankie right there. No guarantees you're going to make money, so there is definitely some risk involved. So what we're going to talk about today is I've picked out a handful of markets, and we're going to just kind of pay attention to seasonality, high probability technical setups. Again, no guarantees, but there's some things that we're looking at that seem like they could be decent ideas going forward. And we're going to talk about, just briefly, we don't have a whole lot of time, but we'll talk about briefly the idea of trading with room for error, because a lot of people can pick the direction of a market, right? For example, maybe they say crude oil is going down from here, or the stock market's going to go down over the next couple months. But just picking that direction is there's a big difference between doing that and actually making money on it, even if you're right. And the difference is, if you're trading futures, maybe you get stopped out. If you are trading options, maybe you just run out of time because options have time limits, so on and so forth. So there's a lot of things that can go wrong, but hopefully they don't. All right, so let's take a look at some live charts. Let me switch my screen share here. Okay, so hopefully you can see my quote board.
Yeah.
Okay, all right. So the first market we're going to look at is the US dollar. Now, believe it or not, I believe that the dollar is in the process of bottoming. That is not a popular belief. Most people believe that this trend in the dollar will continue and will continue to dribble lower. And the idea is, from a fundamental standpoint, the belief is that the US government continues to print money and it's devaluing the dollar and so on and so forth. And that's why we've got this big sell-off that we had from, it started, well, we can say it started in September, October, and has continued through January. But I actually think that this is probably some sort of a reverse head and shoulders. And I think we probably move up. And I believe it or not, I think we're going back to about 94, 95, which is up in this area. Now, I'm just giving you opinion. That's not really a high probability setup, but I'll show you maybe what might be a little more convincing. Let's look at the monthly chart. So one thing to keep in mind when you're looking at commodities or currencies or things like that is, first of all, when everybody is on the same side of the trade, that's usually a red flag. I'm gonna pull up the COT report real quick here. I apologize, I don't have it up already. So a lot of you probably aren't familiar with the COT report. What the COT report is, it's the Commitment of Traders report. It's issued by the CFTC, which is the Commodity Futures Trading Commission here in the United States. And what it does is it tells us who's long and short the market. When I say who, I'm simply saying what type of trader. So we're not listing names here. We're not saying Warren Buffett's long or short the dollar. What we're saying is the large traders or the small traders, so the speculators, either large or small, or the commercials, we can see whether they're long, short, or neutral. We can also see where managed money is. And when we talk about managed money, that's fund managers. So that's like CTAs or hedge funds or things like that. So hopefully you can see this. I know it's a little bit, let me see if I can zoom in. Okay. So this is the US dollar. This is the market we were just looking at. But this is with a COT overlay. So what we can see here is, again, who's long or short? Where are the speculators? What I tend to look for in the COT report is when speculators get overly aggressive in one direction or the other. Are they too long or are they too short? And the reason that matters is because if everybody everybody and their dog is long a market or is short a market, everyone has a position in the same side, eventually you get to a point where you simply run out of buyers or sellers, right? If everybody's already long, who's going to be the next person to buy? Maybe there's not anybody. Maybe everybody's already spent their money and taken action and that's it. And which is ironically why you see in markets a lot of times when the fundamental story is the loudest and the most convincing is exactly when the markets tend to turn around and go the other way. And so what we're seeing in the dollar here is this. Let me make this a little thicker. Okay. So what we're looking at is this green line. It might be hard to see, but basically in a nutshell, the green line is large speculators. Large speculators are net short the dollar more than they have been in maybe decades. Actually, I want to say ever. I think it's gotten to a point where they're holding more shorts than they've ever held in the dollar. Obviously, traders are extremely bearish, right? But what I'm wondering is, has everybody already taken action? If everybody's already sold, there might not be anyone left to sell. And so that's what we're paying attention to. And when that happens, it doesn't matter if the fundamental picture changes or doesn't change, the dollar is going to go up. And another thing to keep in mind with the US dollar is the US has an interest rate differential that's pretty hefty. If you look at, for example, like the German Bund, which is their 10-year treasury or 10-year fixed income security, it's yielding a negative 0.5% roughly. And in the US, our 10-year is yielding 1.1, 1.2%. It's hovering in that area. So at some point, investors from overseas might look at that and say, hey, I want that 1% yield instead of getting negative yield. I'm going to get something. Now, in the overall scheme of things, these are very, very low yields, and I'm very aware of that. But the yields in the US, although low, are higher than anywhere else relative to the same risk. And so that should, in theory, bring money into the dollar. And I think it will reverse this trend. I think everybody that's short the dollar might reconsider their position eventually. This isn't something that's going to happen today or tomorrow, but it might be over the next month or so. So just be on the lookout for that. Okay, going back to the dollar chart here. I believe this is a relatively high probability setup. You can see that, let's go zoom out. You can see that the dollar did seem to break through this little trend line here. We had a trend line that dates back to 2011. And at these areas, the market has held very well. In December of this year, it broke through support and is now bouncing along, trying to figure out where to go. Now the market this is a monthly chart, by the way, and you can see we're extremely oversold. Being oversold doesn't guarantee that the market's going to turn around, but like the COT report we were just looking at, it's a pretty good indicator that maybe all the selling's behind us. Everybody's already reacted to the bearish news, and things might start heading the other way. Even though we broke support here, I'm not too concerned about that because of the time of year we did it. We did it over the Christmas holiday, and we all know during that time of year, markets do things that maybe they otherwise wouldn't have done. So I'm not going to sweat it too bad. As long as the dollar stays above 88, and this is a dollar index future, by the way, as long as stuff stays above 88, I think that our thesis is still going to carry water. And seasonally, the dollar does tend to move a little higher this time of year. So seasonals are also in line. All right, another market we're going to look at is crude oil. Let me get to a monthly chart here. So this is the monthly chart of oil. We all, it's old. So this is the really big picture. Now, crude oil is a tough market because it's literally feast or famine. It's either rallying sharply or crashing, and there's really rarely any in between. That's just how this market is. So a lot of you probably remember hearing about negative crude oil prices earlier in 2020. It was like in April, May area was when everything kind of started. Well, it started melting down in February, but by April, May, crude oil prices were actually trading in negative territory, or at least that was the media story. In reality, the only contract that went into negative territory was the front month. It was expiring on that very day. There was probably a handful of contracts that actually traded at those negative prices. So it's kind of fake news. Realistically, the back month stayed, the high teens is really the lowest that the back months got. So if people tell you crude oil went negative, it's technically true, but not really. Not for the average trader. Most people are trading the back months. So we can see that crude's coming up against a really, coming up against a downtrend line here, which I do believe will hold. In fact, I think crude oil, probably most of this rally is behind us. I think we start to pull back and head the other way sooner rather than later. That too is kind of an unpopular thought. It's ironic because in March and April, nobody thought crude would ever come back. Everybody thought crude was in the basement forever. And now everybody thinks crude is going to be high forever. So it's the exact opposite of what we saw. But we're starting to look at some of these technical indicators, seeing that crude oil is getting overbought. This is a monthly chart, by the way. This is the really big picture chart. If we zoom into some of the shorter end, which I will in a second, you'll see that it's actually even more so. But this chart actually points out in crude oil, we've had multiple 80% declines. Now the size of those declines have shrunk because the price of crude oil has tamed itself a little bit. When I started in the business, it's over here, crude was trading around, actually when I started, I take it back. It was probably right around here. We were below 40 in crude. I remember when crude oil broke above 40, it was a really big deal. Everyone made a big deal about it. Now 40 feels cheap to most people. So it's really interesting how things go. But we made it all the way to $150 per barrel before collapsing down to the $30 area. And we've done that a few times, but with lower highs and higher lows until here. But again, this is a little bit of fake news. So to be honest, I don't really think we broke much below this line on the back months. All right, so let's take a look at I'm going to go to the daily chart. Now, the daily chart is a little concerning to me. Normally, crude oil actually, from a seasonal standpoint, crude oil actually starts to go up this time of year. But like I had mentioned, we're already at a multi-month high. So I'm interested to see how seasonals play out. I would be surprised to see crude oil go up from here, even though seasonally that's normally what it does. I think we might get a bit of a counter seasonal move. This is what we've seen in the last couple of months in crude oil, and you can see we're extremely overbought. We haven't been this overbought in crude oil in years. That doesn't mean that it's guaranteed to go back down, but that means that the market's definitely overheated. Markets tend to go up or down in 45-degree angles, and this market's quite a bit steeper than that. Probably a natural incline would be more like this. Let's take a look at the COT report for crude, because you'll see that there's actually not record net long positions in crude oil, but very, speculators are very long crude oil, which to me is a bit of a warning sign. Okay. By the way, if you are interested in trading commodities and you're interested in the COT report, a good free source of it is barchart.com. Barchart.com is actually great for many things, but when it comes to the COT report, it's really great because it'll give you free access to information that otherwise would be quite expensive. Okay. Okay, here we go. So this is our COT report for crude oil, and this actually dates back to 2016. But if we went back further, you would actually see that this is a very extreme position in crude. So right now we have about roughly 500, let me see, about 500,000 net long positions in crude oil held by speculators. That's pretty extreme. The last few times that we've seen those types of extremes are right here and right here, which you can see it sold off temporarily, but then eventually went down here. But anytime you get up into these levels of extreme net longs in a market, again, you get to a position where maybe all the longs are already in, and you can see what happens when those longs liquidate. Sometimes it can be really ugly. In this situation, crude went from 80 to 40, so at 50-cent drawdown in a handful of weeks. So it can be pretty devastating once the market realizes everybody's long and needs to liquidate. Now, will we get something like that here? I wouldn't be shocked. I think we could see $40. I'm not looking for much below that. I think we hold probably some sort of a trend line here, but the odds are, even though fundamentals are bullish and even though everything looks great for crude oil, the odds are we get a pullback, and the reason being everybody's already long. So again, this is one of those higher probability situations where there's no guarantee, but pretty good chance speculators start to liquidate at some point. And if they do, it's inevitable. The only way, if you're long a futures contract, the only way to get out is to sell, right? So if they sell, the market will come down. Another thing to keep in mind also is with commodities are somewhat dependent on, actually very dependent on the value of the dollar. So if the dollar goes up, that'll put downward pressure on commodities. If you overlaid a chart with the dollar, US dollar and crude oil, you would see they actually are moving exactly the opposite. So during this time, crude oil is going higher, but the US dollar has been going lower. If the dollar turns around and goes higher, guess what? Crude oil's going to go lower. And again, it doesn't matter. Fundamentals, literally, everyone wants to talk about supply and demand and Cushing, Oklahoma and OPEC and all those things. It's really not going to matter. If the dollar goes up, crude oil will come down. That's just how it works. The other market we're going to take a look at is silver. Silver's gotten a lot of interest here because of the short squeeze we talked about. Now, this is a 60-minute chart in silver. I like to look at, if I'm looking at intraday charts, I use a 60-minute, just as an FYI. You can use any time frame you want, but 60 minutes gives me a pretty good idea of what the trend is, where support and resistance is. And you get to see 2 or 3 weeks at a time, depending on the charting service you use. But let's go to a daily chart here. So earlier in this session, I was talking about the short squeeze in silver, and that's that's right here. It might be hard to see. I'll try to zoom in a little. So there was this giant short squeeze in silver. It was temporary, it only lasted a few days, but what generally happens is when a market makes a big spike like that, usually it retests that. We can come back and look at some of these previous situations here. It's not perfect. When markets are spiking one way or the other, things get messy. So like on this price spike, we see it retested it and went a little higher. On this price spike, we tested it. Over here, we spiked and then we tested it and went a little higher. So that's generally the pattern in silver, and honestly, in most markets, that's how it works. So what we're thinking is we had this big price spike. I mean, sure, it was induced by internet traders trying to corner the market and failing, but we do think it probably goes up and retests that, maybe even goes slightly higher. But ultimately, the odds of silver going much higher than that are probably not that great, because if we're right about the US dollar going up, that's going to put some pressure on silver, at least keep a cap on the rally. If we take a look at a monthly chart, we can get a better idea of what the big picture is. And to me, this is a relatively high probability setup, not necessarily the retesting of 30, but when we do start getting up into these, the $30 price range, and maybe even as high as 35, 35.50, I'm not saying that we will do that, but there's about a 60, 70% chance that we run stops above 31 and people get excited and we get into the mid 30s. But those areas up there will probably be very high probability places for bears to start to position themselves. Now, silver is a dangerous market, so you want to keep anything you do on a small scale because you don't want to get caught in the whirlwind. You can see back in 2010, 11, silver had a huge run up to $50, and it was a one-way street. It literally it rarely pulled back. It just went one direction and that was it. And then from then on out, we've given it all back, plus and traded sideways for a decade. So that's the kind of market that metals can be at times. So again, if you're a bear, the high probability setup would be waiting for extreme overbought conditions somewhere up above 30, maybe even as high as 35. But keep positions limited, risk limited, or at least small, so that you can manage the risk. The most likely scenario is we come back down to this trend line here on a weekly chart, which is about 22. And I think it'll probably get pretty comfortable in there. I'm not sure that we're going to see these levels again. And the reason being, silver is now more of an industrial metal than a precious metal. It's a little bit of both, but silver is used in a lot of the electric vehicles that are so popular now, Tesla and things like that. So there's definitely a use for silver that should keep its value somewhere up above 20. So 22 would be an area to look for. Are we running out of time?
I think you can wind up with your presentation, then we do the Q&A. Okay.
All right. So one more thing I'm gonna just take a look at real quick, and then I'll shut it down, is the NASDAQ. I want to point out to anybody that's following the stock market and seeing what's going on in stocks, it feels like stocks only go up, right? And that has been the case. It's been the case for a long time here, but there's definitely some reason to be cautious. It's not the easy money that some of these kids think maybe it is. Here's a very eye-opening picture. The NASDAQ has traveled 7,000 points from the March low to where we are now. It's actually a little more than that, but we're just rounding. So about 7,000 points from March to now in roughly 10, 11 months. The prior 7,000 points took 10 years. So you have to ask yourself, have we just basically pulled forward the earnings for the next several years? I think maybe that's what happened. So I'm not telling you to go short the NASDAQ. I'm just saying, be aware, be woke of what we're seeing here. This is not normal. These are not normal markets, and they haven't been for a while. So we'll see how it goes going forward, but we shouldn't expect 10 years worth of gains in 10 months in any market. And when you see that, it's definitely a red flag waving.
Mm.
So I just want to thank everybody for coming out. Again, if you're interested in trading commodities and you want to learn more, we have quite a bit of educational material on dcarleytrading.com. And again, if you're interested in learning more about our books, we try to keep the books very affordable. I hope you have access to Amazon. Amazon has my books on Kindle for very cheap. The beginner's book is only, I think, $2.99. But here it is. If you're interested in option trading, this is the newest book, Trading Commodity Options with Creativity. And there's my contact information. So, okay, I'm done. You can take over. If anyone has any questions, I'd be happy to answer those.
Yeah.
All right. Thank you so much, Carley, for that.
Sure. You're welcome.
I've seen some questions coming through. There's one from Samson who's saying, any thoughts on the current gold to silver ratio? And do you think it's too high?
So it's been a couple days since I've looked at the gold to silver ratio. In my opinion, I do think silver is probably poised to outperform gold here in the next little while, which is mostly based on the fact that I think silver has a little bit of catching up to do, but I don't consider it to be extreme enough to make a big deal. Like, that's not one of the primary things that I'm focusing on. I'm looking at, with silver, I think at this point, it's more of a speculators and emotional market. And so I'm focusing more on that side of things as opposed to the fundamental side of gold and silver. But I do think that the ratio does suggest that we're probably going to see some silver outperformance here, at least in the next 6 months to a year.
Okay. Have you done any analysis on gold that you could take us through?
Sure. Yeah, we do. We look at gold quite often. I'll go to a really quick chart here. This is not going to be a pretty picture for anybody that loves the idea of gold going to 5,000 or 7,000, whatever the calls are. And maybe those things do happen. But the problem with gold is gold is a feast or famine market. We've had decades where it trades sideways, kind of like what we've had now. I mean, anyone that bought gold in 2011 is lucky if they got their money back, because here we are 10 years later. So the gold is a trader's market, not necessarily a buy and hold market, or at least that's what it's been historically. I know people point to this and they see gold going up, but that was a decade ago. And these don't look like big corrections because of all the craziness we've seen in the last several years, but these were pretty big corrections on a percentage basis. So even if you were a buy and holder in gold, doesn't necessarily mean that you rode out this entire ride. You might have gotten shaken out here at any of these points. So gold's a really tough market to be a buy and holder, but there are definitely some people that do that. That said, the only reason I bring that up is gold is obviously this is a monthly chart. So this is the really big picture. Gold's obviously in an uptrend. We can see that with the moving averages, but this is a really big wall. I have a hard time seeing gold get above 22,000, 2,100. We maybe at the very most, if we do run some stops, we might see 2,300. But ultimately, we have to keep in mind any big run in gold is eventually going to be followed by a really big correction. That's just how gold works. It's usually a 20 to 40% correction. To put this into perspective, if this continues to correct, a 25% correction would put us at 1575. A 40% correction would be all the way down at 1260, and that is not impossible. I know people think it is, but it's not. That's actually the trend line. So if we came down here, that would actually be this uptrend line. So don't get caught up in the idea that gold can only go up, especially with all the chaos going on in the world, because that is not true. Especially if the dollar recovers, gold will have a hard time going up. So keep that in mind. I'm not necessarily bearish gold from these levels. In fact, I think similar to silver, I think we go back up from here and kind of retest some of these highs. But in the overall scheme of things, don't look at $1,800 gold as cheap, because it's not cheap. In fact, it's actually very expensive.
Okay, thank you. I can see on your chart you have quite a number of technical tools. I see something that looks like Bollinger Bands. I can see some 2 moving averages. I can also see some trend lines. So David is asking, what are the different types of technical tools you'd recommend for
So
this market?
sure. So I like to keep things simple. The thing about technical analysis is if you draw a million lines on a chart, eventually one of them is going to hold, right? So there's that, but I generally keep it very simple. So the indicators that I use are RSI, relative strength index. Honestly, any oscillator you use is basically going to tell you the same thing, just either faster or slower. So they're all based on the same thing. They're all based on previous price action, and they try to attempt to tell us where the market might be going based on where it's been. Some are faster, some are slower, but other than that, and if you took every buy signal and every sell signal that any particular oscillator provided, you're probably going to end up about the same in the end, just because that's how they are. So that said, I use RSI. You don't have to use RSI if you find something that fits your particular strategy or mindset better as far as how quick or fat or slow it is, that's fine. But RSI gives me a good idea of what the trend is and whether things are overbought or oversold. As far as trend lines, I just keep it real simple. Normal, looking for trading channels, looking for long-term trends. I do look at Bollinger Bands. Bollinger Bands is basically like a statistical display of 2 standard deviations. The idea is roughly 96% of the time, the market's going to stay within those bands. One thing to keep in mind, if you do look at Bollinger Bands, don't get caught up in this kind of stuff, because when the bands are really tight and narrow and they break through, it can be a really big breakout. And you don't want to get caught in the idea of thinking this is crazy overbought because we're outside of the band, when in reality the band was so narrow it needed to expand. So it's a little bit tricky with that, but when you look at the bands expanded in this time period, I think you can find that they'll be relatively accurate. The market's going to have a hard time getting above or below those bands, and so that's just kind of a parameter to keep in mind. As far as the moving average goes, on this chart I'm showing I've got a 20, these are simple moving averages. I've got a 20, a 5, and a 13. I mean, they're just to kind of give me the overall. I generally pay attention to the 20 and the 13, but everybody has their idea of which ones are better, and it's just a guidance. I'm not like making decisions based on that, but I just like to see, what they look like. So.
Okay, thank you. I also had something to do with, now that you mentioned Reddit, the guys on Reddit, the retail traders, what's your take on what was going on with GameStop stock? And do you think that retail traders have a chance to go against the hedge funds in future? Is it something that retail traders can be able to keep doing, or now that the hedge funds have caught on to them, then, that was it? It was just maybe
Sure.
1, 2, 3 trades.
They were well organized and they were very smart about how they went about it. I'm interested to see if there's going to be any regulatory issues that come out with that, because basically what they did, and I'm not saying it's good or bad. I'm not saying I'm for it or against it. I'm just saying, like in our industry, if brokers or industry insiders colluded and came up with some sort of scheme like that, we'd be put in jail. so it's going to be really interesting to see how it goes. It's basically a pump and dump scheme is what it is. And in the old days, it used to be something that was done by phone. And again, people in our industry would get arrested for that sort of thing. It used to be they'd have a room full of guys cold calling people and talking them into buying a particular stock to pump it up. And then now that with the internet and people congregating on forums, it's a whole different ballgame. You can reach more people quicker. And so they've definitely obviously had some success with that. There might be some rules and regulations. Again, I'm not saying I'm for it or against it. I'm just saying there might be some things that come in to tamper that sort of thing. So they've got a lot working against them. I mean, not only the market is probably a lot bigger than they are, but there might be some compliance issues as well. And as we all saw with you know, a lot of them are trading on the deeper discount brokerage firms, which just simply don't have the capital or the risk tolerance to handle that sort of business. So if they really wanted to continue and have another chance at doing that sort of thing going forward, they would all need to migrate to a more legitimate brokerage firm that could handle that kind of business and that kind of volume. So that's one thing as well. I don't know. I mean, I really am on the fence. I'm not sure if they'll be able to repeat it. I have serious doubts. The thing of, like I mentioned, the first thing I said is trading success is temporary. And sometimes what works one time never works again, or sometimes something that works for a couple of years just stops working and never works again. So I have serious doubts as to whether that we'll see anything like that again in my lifetime, but we'll see.
All right, thank you for that. I can see you avoided naming the brokerage platform that they were using. But are there, for your commodity options, because you also trade options, are there any particular brokers that you'd recommend or platforms to trade those commodity options?
So, I mean, I'm super biased because I am a commodity broker. So hopefully anybody that's interested in trading commodities or commodity options at least considers our brokerage. We're dcarleytrading.com, and we offer brokerage services that range from discount online trading. So most of our clients are trading through a platform. We offer like 30 different platforms, so there's plenty to choose from. Or some of our clients prefer broker assisted. They like to talk to somebody. They like someone else to help them place their order, because it can be a little bit overwhelming when you're trading options if you don't know what you're doing and you have, you aren't sure. In commodities, unlike stocks, almost every market has a different point value. So it takes a little getting used to and a little time to learn what each point value is worth in each commodity. So for example, what I mean by that is, in silver, every penny that the futures market moves in silver, a trader makes or loses $50. But in gold, for every dollar that gold moves, a trader makes or loses $100. But if you're talking about treasuries, for every tick, it's $31.25. So someone like me that's been doing this forever, it's easy to me, I know it. But somebody that's new coming in, it's really overwhelming. So a lot of people like to start out broker assisted and then move towards online trading. And that's something that we offer that most brokerages do not. Most brokerages nowadays, they're in the business of just offering a platform, giving you a username and password and just letting you go. And they don't give you any type of support, answer any questions, that sort of thing. That's where we're different.
Okay, thank you. So for the last question, so that you can wind up, this is coming from George. He's asking, what do you think about the new administration under President Biden? Do you think his administration will have such a huge impact on the financial markets? For example, like how Trump was giving big tax breaks. So do you think under Biden we'll see a change in the markets?
I think we already have seen a change in the markets. For example, a lot of the crude oil has almost doubled since Biden was elected. So so there's definitely, when I was years ago, I kind of actually, let's put it this way. Before Trump was elected in 2016, I kind of underestimated the impact that politicians can have on the markets. I mean, obviously, it's obvious that their policies can move the markets. But what I didn't understand was policies could move the commodity markets as much as they did. Like with the Trump trade wars and things like that really wreaked havoc on the grain markets, maybe for better good in the long run, maybe not. I don't think we've learned that yet. But the reality is it really can make a difference in how the markets behave. And we're seeing that again with oil in the Biden administration. So I do think things will change, and it's a matter of just adapting to the new reality. One thing I do want to point out is something that I think is interesting is the S&P in the last 4 or 5 years has been insanely volatile. We've seen some really big switchbacks. But prior to election night 2016, this is what this mark is right here. Right here, this is election night 2016. You can see the volatility was very low. And then as soon as Trump won, suddenly volatility, this is the tax cut rally. And then from there, it was literally like this. Now, the overall direction was positive. So people with 401ks and long-term investments, that was awesome for them because the market overall is assuming that they didn't panic and liquidate at these points. If they were in for the ride, they did very well. But there's definitely a difference in volatility. And again, I'm not trying to get political. It's not good or bad because, the policies themselves were good for the economy. And that's why the market and the economy in the US did as well as it did. But it was not without a price to pay. And that price was volatility. In any other time in market history, you don't really see this kind of crazy volatility. Even in 2008, when we had a sell-off, it was pretty orderly when you consider what happened then, or even in 2000, the sell-off was kind of a dribble lower as opposed to now. Now, that's not all politics. There's other things involved. For example, algo trading, computer trading, Robinhood traders, that sort of thing are all playing. Everybody has such quick and easy access to the markets now that they didn't have before. That speeds up the process of a correction. So a lot of it is that, but a lot of it also is differences in political administration. So something to keep an eye on. I personally believe that the stock market, this is the S&P, I personally believe it's extremely overheated and due for a pullback, pretty big pullback, maybe even somewhere in here, 3,000. But what I also believe is the volatility is probably going to decrease as we go forward, whether you agree with the new administration's policies or not. They're probably not going to be quite as transparent, and that lack of transparency might actually calm the markets down a little bit. So that's kind of my thoughts going in, but we'll have to take it day by day and see how it goes.
All right, thank you so much, Carley. Yes.
All right, thank you, Gilbert, for that session. Carley, we really appreciate your time. And then maybe as we conclude, you can tell us where people can go to find you. I think you mentioned your Twitter handle, and maybe you can recommend trading books on commodities. You can mention your books as well as the timing on when your market analysis goes live on Bloomberg for guys to watch out for.
Sure. So this is my contact information. There's my email address if you want to send me an email, or you can find me on social media. Just search Carley Garner and it'll pop up. As far as the Bloomberg thing, we do a segment. It's called Options Insight on Bloomberg. We do it roughly once or a week, or maybe once every other week. They're generally not scheduled too far in advance, but I do know that for sure there's going to be one on the 19th of this month. So if you happen to have Bloomberg on the 19th, the time of day is I'm not going to attempt to convert it to Nairobi time, but the time of day is 3:15 Eastern. So at 3:15 Eastern on Bloomberg, I'll be talking about options on the 19th. So that's next Friday. Again, here's my contact information. Let me go back to, if you're interested in the books, tradingcommodityoptions.com has a lot of information on my latest book, which is this one, as well as some of the others. And hopefully you have access to Amazon. Amazon's really the cheapest way to get access to the books, but in theory, you could get them at any major book outlet, but especially for you being overseas, Amazon's probably going to be your best bet. And they sell them the ebook version, which is viewable on PCs or as well as Kindle. So.
All right, so that's 3:15 EST PM next week.
3:15 Eastern. Yes, correct. Yes.
All right, Carley, thank you so much. I know it's
You're
a little
welcome.
bit very early for you. And
it is.
we will do this again very soon when we will have you on live video. Thank you so much for
Sounds good.
Giving your time for us. So
sure.
And guys, we continue to ask you if you want to apply these lessons that we get from our networks. You can start off by opening a live trading account with Scope Markets Kenya. You can also look to open an account with Carley Trading as well. And there's an update on an ongoing trading competition, ultimate trading competition with Scope Markets. It's running the entire month of February. So those of you interested can fund your trading account. The minimum is $200, and then they will take it up from there. So thank you, Carley. Until next time, have a great morning. Cheers. Bye.
You too. Bye.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.